Can you hear me? Everyone, I'm sorry that we're slightly late. I'll call this meeting to order at 9:02 a.m. Today is Tuesday, May the 20th. My name is Christine Novello. I'm a governing board director. I'm also the governing board treasurer and the chairperson for today's meeting. So welcome to our Budget and Finance Committee meeting for May the 20th. The first thing we'll do is rise if you are able and join me in the Pledge of Allegiance, please. Thank you, everyone. And again, we do have a few folks who are absent today, but we have quorum. We're also joined remotely by two of our committee members, Mickey Jacobs and Ed Westall, are attending via Zoom. So you will hear them, although you will not see them. And thank you for joining us. We are indeed, in the midst of several of our neighbors heading back to their cool weather climates. So thank you again for joining us, Mickey and Ed. I'll now read our meeting procedures. The governing board and its committees conduct all of their meetings in compliance with Arizona Planned Community Association open meeting laws per ARS 33-1804 and in concert with RCSCW bylaws, policies, and standing rules. Parliamentary procedures as outlined in the most recent edition of Robert's Rules of Order will also be followed in all meetings as appropriate, consistent with Bylaw 3.07, Procedures for Owner-Member Meetings, and Standing Rules number 2 and number 3. For those of you here in the audience, welcome to our fellow owner members. To those of you who are attending remotely, welcome as well. You are welcome to submit comments and questions via chat. And please include, in all cases, when you step to the microphone or in chat, include your name and your owner rec card number, please. Very appreciative. With that, we'll move on to 2.01, our meeting minutes from our last meeting, which was May the 6th. Are there any corrections, concerns with the minutes? I'm seeing no's in the room. Ed, Mickey, please speak up if there are any objections. Hearing none, those meeting minutes are approved by consensus. We'll move on now to Section 3, New Business. At the start of our agenda, we have a presentation on our insurance renewal and review. We would welcome any comments from our CFO, Cliff Swan, and we welcome to the microphone John Newhouse of Brown & Brown. I wanted to say Hayes, but it's Brown & Brown, correct? Cliff, are there any other introduction comments that you'd like to make?
Just a little bit of context here. I just want to talk a little bit about what we have here to insure. I mean, obviously we see the various buildings that we have, the golf courses and bowling alley, but just to give some more context, I've got a resource inventory report here that I just want to kind of read off some of the things that that are here that we have to insure. We've got 240 AC units, 28 swamp coolers, 80 exhaust fans. We've got 54 hot water heaters. We have 100 backflows. We have 208 toilets, 67 urinals. We've got over 1 million gallons of pool and spa water. We've got 159 pieces of exercise equipment. We've got 151 roofs at our 54 buildings that we have to insure. We got 257,000 square feet of floor coverings. We've got over 2 million square feet of parking lots here at our rec centers of Sun City West. We have 4 miles of common walls that we have here. So just to give a little bit of context to what we insure and what we have to make sure that we have insurance for, over 100 vehicles and carts that we insure as well. I'll turn it now over to Mr. Newhouse to talk a little bit about what we went through with our renewal process this year.
Thank you. My name's John Newhouse. I'm with Brown & Brown, formerly of Hayes Companies. We've worked with Sun City West for in excess of 10 years. I am also joined by...
I'm Christy Brown. I'm your account executive. This is my second year working on your account with John. It's been a pleasure.
Thank you. Annually, we have an insurance renewal for the property casualty insurance for Sun City West, and many of the items that were listed are items that we look to insure. In addition, we are insuring various liability items. So think of those situations where someone slips and falls in the parking lot, or someone gets hurt at the bowling alley, or someone gets, a rash or something potentially at the golf course due to the chemicals that are used on the golf course. So there's a wide range of items that we are responsible for insuring for Sun City West. On an annual basis, we do an inventory of which some of the items that Cliff listed are those items that get included in there, as well as a wide range of other items that we go about insuring. So just to give you a quick update, I'll let Christy introduce kind of the team that works on your account. We'll give you some updates. We got the current program structure that we have. We'll go through the insurance summary that we went through. Ultimately, you all want to know what the premiums are, and we'll touch on that, and then we'll touch on the state of the market for you. Okay, so Christy?
All right, so we've got our team. It starts out with John and myself. We are your contacts for anything day-to-day that you need that should come up. We are there for you to reach out to and to assist with. We have some team members that help us with some specific areas. Starting out with your cyber, we've got Randy Raveling. He's helped with the marketing and anything cyber that comes up for rec centers the past couple years. Then we also have the executive risk senior vice president, Scott Stentz, does the same thing as Randy would assist us with anything executive risk, directors and officers, those along those lines. We've got Tom Goltz. He is our risk control. So anything that you need, that we need assistance for on your risk or safety or anything we can do for risk management, he can assist with that. Our claims management, we've got Scott Turner that helps with claims. Also with him is Chris Hall, who's been helping a little bit on our some claims that come up for rec centers. They're a great contact. They're the advocate that can help assist rec centers work with the carriers on any claims that come up. And then we have Nate Kuzi in analytics. He helps us run the numbers and come up with strategies on what we can do for you on with your insurance year over year. Sure. So we've been over 10 years now. Rec Centers has been with Philadelphia, your carrier. We had some pre-renewal discussions with them in about February, March to start the renewal process. When we talked to them about this year renewal for 2025, as the last couple years, they let us know they were going to apply a 5% increase to the property building limits automatically on top of increases that we'd seen happen the past few years on the buildings. Some specific ones that they were wanting to increase at a higher level were the sports pavilion, the sports and therapy aquatics building, and the Stardust Theater. So they wanted to do a increase from 61 million and some change to 67 million and some change. With seeing them implement this the last few years, they've been a great program. You guys have been with them, and they do very well with rec centers and the type of program that you guys have. But just seeing year over year, we went to market this year, which we've done in the past, but this year going to market, we've had some new carriers that nibbled and wanted to take a look at the program. Your gross sales increased 6.9% with the majority of it happening with the golf clubs and bowling alleys, which we've seen the last couple of years, people getting involved with those two for the most part.
Just a little further color on Philadelphia. As what has been happening in the property casualty insurance marketplace is insurance companies have traditionally, in past years, have taken lots and lots of risk on an individual basis. And one of the things we started to see from Philadelphia, as well as the general marketplace, is carriers are cutting back capacity. And when we say cutting back capacity, for instance, Philadelphia used to offer a 10 million umbrella for you guys. Well, this year they were only willing to offer a $5 million umbrella. And part of that is all predicated upon the fact that the insurance companies are having to pay $10 million claims on a much more frequent basis than they used to. The second thing that we're starting to see in the marketplace, because of the profitability of the insurance companies, are they're pushing deductibles up some. for our clients. And so, for example, last year on your property, you guys had a $5,000 deductible. This year, Philadelphia, as well as the general marketplace, i.e. the other insurance companies that we approached, they all were requiring a $25,000 deductible. And the insurance company looks at that, and they look at you as a business that has, nearly 70 million in assets, and they feel that you guys should be able to assume a $25,000 deductible. And we don't want to see our clients get into a game of trading dollars with the insurance company. So it was a further way for us to manage costs for you guys during the renewal process. Any questions?
Not yet. We'll save them to the end. I'm sure we'll have plenty, but
Yep,
thank you so much.
Please do. Christy, do you want to touch on Cincinnati?
Yeah, so when we went to market, a couple years ago, we were partnered with Cincinnati, and this year I went to our underwriter and brought this program and introduced your program to them, and they were very interested. Worked with the underwriter to develop a package that aligns with what you've had with Philadelphia year over year, and they were able to provide a very competitive quote for us and present to you guys. They provided the quote. They were willing to use your expiring building limits, so we didn't have to see that increase that Philadelphia was implementing, which resulted in 10% of premium savings. The general liability rate also, they were able to quote quite a lot lower than Philadelphia. It was 23% lower, using your same exposures and revenues between the two carriers. Liquor, inland marine, employee benefits lines also came in 19% lower than the current carrier of Philadelphia. Your umbrella limit with no retention versus a $10,000 retention with Philadelphia, which is the same as a deductible. And both carriers, as John just mentioned, increased the deductible from $10,000 to $25,000, so that was the same. Both carriers also, some of their things they've gone back on are the flood was $5 million, and they both would only quote a $2 million limit, which not really a flood zone here, so it's not a huge thing that you guys are missing out on. And we worked with the carriers with the lower capacity from the carriers on the umbrella going from a 10 million to a 5 million. We just restructured with other carriers, so we didn't lose any limit. We remained with the same limits, but we did some restructuring for that to happen this year.
So as you can sense probably from our presentation, we did go aggressively out to the marketplace with your account, and we've made the recommendation for you guys to move from Philadelphia to Cincinnati Insurance Company. We take those changes very seriously when we look to change carriers, because we do value the relationships that you guys have developed over time with Philadelphia. But with the changes that Philadelphia was continuing to push, and I'll just highlight a few of them. One is they have been pushing really hard over the last number of years on continuing to increase your property values, which is a direct function of the total premium that you're going to pay. So every year they've been pushing for you guys to increase property values. And so we have to push back sometimes against them. And we did, but they still required that increase took place. A second change, which was market-driven, was the umbrella limits decreasing from the 10 million to the 5 million that you had. Now, at the end of the day, you end up with the same total limit. So when Christy used the term, we had to restructure it. You buy 25 million of umbrella. You're still buying 25 million, but we just had to get some different carriers and a different combination of carriers to write that. Third is the D&O insurance, which is part of your total package. Last year, you bought 10 million of D&O coverage, of which we got it all with Philadelphia. This year, we had to get two carriers to get to the 10 million of D&O coverage. But again, we end up at the exact same limits purchased. And then, as Christy mentioned, the flood insurance. the carriers are starting to restrict how much flood insurance you guys could buy from them. So we went out and got the most that we could, $2 million from the existing carriers. We did go out to the general marketplace to buy the additional $3 million of D&O coverage so we could have the exact comparable that you had. But after we did the cost benefit analysis for that, it was determined that it wasn't cost effective to buy that additional $3 million. So when you make a change, what we're trying to look at is first and foremost, from a coverage standpoint, is there comparable coverages year over year? And with largely except for the items that I just noted, you do have the similar coverage that you had last year. The next component that we look at is the cost component. And as we'll get into, you'll see that there was an economic benefit to moving to Cincinnati as well. And as Christy mentioned, Cincinnati is a carrier that last year they weren't interested in this account, but we have an underwriter this year that was very interested in the account, and he made a long-term commitment to us to earn your business. So we feel very fortunate that he was able to secure the business for us. So here's a picture of your total insurance program for you. Starting from the left side, sliding across, and I'll try to go relatively quickly. The first is your general liability. As you can see from a total premium perspective, it's $150,000 that you guys are paying there, and you buy a $1 million limit. Sitting on top of that is 3 more boxes that allow you to get to that $25 million of total coverage. So you could have one general liability claim and you could pay out $26 million if you had an adverse situation that happened. Employee benefits liability, think of that as HR, E&O. So your HR department fails to enroll someone in some type of pension plan or life insurance. There could be a claim that comes there. Underneath your program, you've got a $1 million limit for fitness and health. As mentioned, Cliff mentioned, you have about 100 autos between golf carts and trucks and private passenger vehicles. You've got a $1 million limit for that with a $1,000 deductible for comp and collision. And again, that umbrella sits over the top of that. We serve alcohol on premises here. You have $1 million limit for that, and then again, the $26 million limit sits on top of that. And you can see on the bottom the cost for those line items. The directors and officers insurance, so that's the directors and officers making an error or an omission and they were to get sued. You buy $10 million of coverage there, similar to last year, but how we achieve it is we've got 2 carriers that write that D&O insurance for you. You can see the premium there is about $36,000 for that. The property insurance, which we mentioned earlier, we break the insurance up into a couple of different buckets. One is the total building, so think of this structure here. Think of contents that you guys have. I.e. the tables here and the chairs, those are contents. And then think of if the business goes down or the building goes down, how does that prevent the business from continuing to generate revenue? So the restaurant burns to the ground and the restaurant has historically been able to generate $1 in profit. We want to replace that $1 in profit that you lost. And so when we say the business income, it's not the revenue that you generated. Think of it more similar to the profit that you potentially lost for not having that in place here. Then you see we've got some miscellaneous equipment with ATVs and golf carts that was listed earlier. As a prudent business today, you guys buy cyber insurance. That is an area that we as an organization are seeing claims pretty close to every week. And it seems like I always get a call on Sunday to tell me that their system has been hacked. And so cyber insurance is becoming more and more critical for businesses and will continue to be a key line of insurance. What we have seen in the industry from a cyber perspective is We continue to see increased activity of people hacking into systems somehow, some way. You guys have some wonderful controls, and I can tell that by the low premium that you're paying. But what's happening though is customers, maybe one of your vendors who you have an online link up with, they get hacked because they don't have the same level of control. And then they get in and get access to your members' personally identifiable information, i.e. maybe social security or health insurance numbers. And those are the important things that the hackers are trying to get access to. So a very important item for businesses today. Pollution liability, I mentioned the golf courses earlier. And you know, you guys are spraying chemicals and stuff, and so we want to be prudent and buy coverage for that. Fiduciary liability and crime insurance. So this is insurance that there is theft that takes place of your monies and securities. Fiduciary liability, think of that as probably Cliff and or other people here are fiduciaries of pension and welfare plans that you guys have. So you have that, and then you have a few small bonds in order to be in compliance with the city and state. Christy, if you want to touch on the marketing summary.
Sure. So we sent, as we talked about before, your full package and all lines actually. We had our teams, cyber and executive risk, also market on your behalf. For your package, we always use your incumbent. So Philadelphia did provide a renewal quote as they do year over year. They're very favorable of rec centers, and we're very willing to continue to quote. We got the competitive quote from Cincinnati, which came in very nicely. And we also had a couple others this year that were interested. We've seen in the past few years when we submit to markets, we get some pretty quick declines, just for one reason or another. The combination of rec centers having the recreation portion of it and with the type of community, a lot of the carriers will turn it away pretty quickly. So this year, we were very pleased to see a couple others kind of nibble and bite. So see what happens in the future should we need to look again. We had Chubb that were willing to look at the property only this year. They didn't really want to look at the liability yet. And then RT Specialty does the excess layers, which are the umbrella layers, the 25 million that sits on top of everything. We also had auto owners provide a quote, came in quite a bit higher, so we didn't really use that, but they were ones willing to also quote this year. And then some of the others down there that we went to did decline for different reasons for their appetite. Cyber also went to some markets. The past few years, Rec Centers has been with Hiscox, and they came with limit higher, or they matched expiring, and the limit was actually $1 million last year. Chubb came in with the lower quote and was very competitive, which is what we presented on your structure just on the last slide, and at a $2 million limit. And then your excess flood that we did go get a quote from Amwins, but decided not to pursue due to cost.
All right, so show me the money is what people ultimately ask about at the end of the day. And because again, you're going to ask us to make sure we get the coverages right, but I also got to get the price right. And so maybe just so we can get ourselves level set, if we can kind of start on the left-hand side where it says the expiring box, you can see that last year the property premium was $118,500, and that was based upon the $76 million in value. We mentioned that Philadelphia took those values up. However, Cincinnati did not require it. So you can see what the premium is for the property, the general liability, auto insurance. So you can see what's kind of happening on down by line of coverage. And so you can see that last year, rounding it up, was about $592,000 to get to purchase the package insurance that you guys are required to have. When we look at the general marketplace, which we have some slides in here at the end that talks about the state of the market, there is some pressure still that exists in the marketplace, i.e. rates getting pushed up. I would surmise if I asked the people here, how many of you have seen auto premium increases on your personal autos? I would suspect nearly every one of you would raise your hand. And that's really a function of the liability marketplace experiencing pressure. And what is that predicated on? The auto specifically is really two main factors that we're seeing pressure from the auto. One is the frequency of smaller claims has gotten larger. What do I mean by that? I mean that when a car has an accident today, it's got a lot of electronics in that plastic front bumper, and it costs $5,000 to fix that front bumper, whereas 5-7 years ago, you had a metal steel bumper that was $500. And so we're seeing more and more accidents that costs are increasing because of that. A big part of that is due to distracted driving. Tom Geltz on our chart, for instance, one of his main jobs to talk with our customers about is distracted driving. He lost a daughter to distracted driving, to a person who was texting and driving and came across and killed his daughter. So he's got a very compelling story, and the data would tell us that distracted driving is a huge concern of some of the increased pressure on auto. Another big pressure point for auto, but liability in general, is just the increasing frequency of large claims. And we talk about large claims being those claims that are over $10 million. And that has really put a lot of pressure on the industry. If you looked at the data from 10 years ago of claims that settled over $10 million compared to the claims that settled in 2023, that's the last set of available data that I've seen, the increased number has gone up 8 times. So there's 8 times more claims that have settled over $10 million in 2023 than 10 years ago. And that's causing these insurance companies to have to pay out huge, huge settlements. And so if you think about that, and if you're an underwriter and you put out $25 million in limit a few years ago and you were having to pay that out, well, one way you limit your risk as an underwriter is you look to say, well, I'll still take risk because that's my job, is I have to take risk, but I'm not going to take $25 million. I'm not going to bet all of it. I'm just going to bet $10 million or $15 million. And I mentioned earlier that your umbrella limit decreased from 10 with Philadelphia to 5, and that's a reason why underwriters are doing that. Is I work on many towers where my underwriters, nobody's putting up $25 million in limit. They're either putting up 5, 10, or 15 because they want to limit the potential for loss. And so then we have to share that remaining limit with the other available underwriters. All of that leads us, so we went out and negotiated with Philadelphia. They're the incumbent and they have every right to try to keep your business, and we pushed Philadelphia. The numbers you see here, so 591, this year they're at 727, and if you look to where we started from with Philadelphia, they were originally, I think, closer to 780, Christy, was it? Yeah. So originally they came in at over $780,000, so they were putting tremendous rate pressure on us. And so then we were able, as we were negotiating with Cincinnati, we were able to get Cincinnati to come in. And again, I had to do some restructuring, but again, I get to the same limit structure that you guys had. They came in at 658. So then we went back to Philadelphia and we asked Philadelphia, we said, hey, listen, you guys are still really high. You need to cut your price from that 780. And the most they could cut it was to that 727 mark. And so you guys had to make a business decision what was going to be best for you guys going forward. And so the decision was made at that point to move from Philadelphia to Cincinnati. And we support that. We work with Cincinnati with many, many accounts and feel very comfortable with them as a good long-term player as well. Anything to add, Christy? I've kind of tried to weave in some of the state of the marketplace in my general comments, but what's taken place in the property marketplace, we continue to see a lot of impact of natural disasters. Those can range from earthquakes, hurricanes, floods, and wildfire. And that's another one that we list on there. So what we're seeing in the general property marketplace right now with those pressures is we're seeing rates anywhere increasing from 5% increase to a 5% decrease. Casualty, I've talked a lot about the liability pressure that exists in the marketplace right now. And so I think I've touched on most of these points already. So you can see general liability is increasing about 5 to 10. Auto, we're seeing anywhere from 7.5 to 15% increase. And the umbrella, 10 to 20% increases that we're seeing there. Now, what I would comment on, if I go back to our premium, or wrong direction. I go back to my premium slide here. When we're negotiating with Philadelphia and Cincinnati, since they're writing so many of your lines of coverage, you may see that a certain line of coverage maybe is a decrease over expiring. And the reason for that is they may have different modeling compared to Philadelphia, but they are still, at the end of the day, we're negotiating to a total net bottom line of coverage, right? So somebody may say, boy, their auto premium's way too high. And I'm like, yeah, but their property premium's way lower. And they are looking at both of those lines or all of the lines of coverage to balance and get to the total premium that they think is the right number that they need. Okay. We touched on property, touched on liability, surety. You guys don't have a big surety exposure here, but one interesting thing that Christy and I were just talking about, for instance, is with the tariffs that are taking place. Many of you have probably read the news and picked up on that. Many of our clients that do importing, there's going to be a lot of pressure for those clients on their surety programs. They're going to have to increase the amount of the surety bond that they have because of the increased tariffs that they're going to have. And Christy just got an email before we joined the meeting here today that one of her clients, she had to increase the surety bond, and it still hasn't been accepted by the Import-Export Agency, and so that client is unable to bring in goods until we can get that approved. So just as a little educational note, but you guys don't have too much impact because of the tariffs there. Executive liability, again, it's a smaller line of coverage for you guys, $35,000 in premium, but it's a very important line of coverage for you guys. And the general marketplace has been pretty favorable over the last 18 months for the executive liability coverage. There used to, 2-3 years ago, there was a lot of pressure on public company D&O. Private companies less risky than a public. Even the public company D&O exposure has come down here as well. There's been some tremendous pressure on the cyber marketplace with rates and premiums. It feels like we've, as you can see on the bottom right-hand slide there, you can see that we reached the peak in like 22. And since the peak, the rates have come down about 23%. And what is that a function of? I think it's a function of really the following. One is clients like you have put in much better controls. You've gone and identified best practices, multi-factor authentication, and there's a whole list of best practices that businesses are doing. That's the first thing that's taken place. The second thing that's taking place is the hackers, as they're getting into the system, they're not as greedy as they used to be. When they say they only want, they're trying to come to a point where they can get enough money, because if they demand too much, you guys are going to sit and fight it harder and harder. And so it gets harder for them to get into those long drawn out battles. What they really want is, get me $300,000 and I'll release your data. And so that's not as expensive as having to pay a $3 or a $5 million thing. And then the last thing is, not only is your security good, but you've got backups. And so we've had many clients that have had their systems hacked. And there's a demand to get stuff. Now, the piece that they always worry about is how much personally identifiable information is held. But to get back online, they may only lose 8 hours because they got ready backups that it's easy for them to get back up and running. Losses. At the end of the day, you're buying insurance, I think, for the following reasons. One is peace of mind. You want to know that if you have the big claim, there is insurance in place that can help pay that. The other reason that you buy it is to have insurance to pay for some of the claim activity that you may have. And we've talked in past years about that. You guys have had some auto claims in the past. You've had some large property claims that have taken place. And so that's another reason that you have. And then I think a final reason would be it keeps you in compliance. For instance, workers' comp, you have to buy workers' comp. It's a law. You may have a mortgage on your building, and so, the bank may want to have proof of insurance that you're carrying insurance. So there's a compliance component to why you buy the insurance. So my biggest of big clients, and I work with clients that are much bigger than even the insurance companies they place insurance with, they all buy insurance to some degree, because at the end of the day, when you have the big claim, you want to say, I went out and I was judicious and prudent in how much limit I bought. I balanced all the data and I tried to determine how much was the right limit to buy. And we as an organization bought what we felt was the right limit to protect us at that point in time. And we have an annual basis where we get to redo that. And we have conversations with Cliff and his team about what's taking place in the general marketplace, and give him some indications, what we're seeing. People would say, how do I compare to my peers? And, there's data like that's available, but what I would say is that's assuming that all your peers are making really smart business decisions too. And that's not always the case. And so I always caution my clients when you say, how much does my peer buy? I want to buy what they buy. Well, how do you know that they're buying the right? And so you guys have to balance and look at what is it that concerns you, and what is that claim that we're trying to protect against. There you have it. 40 minutes.
And thank you so much. There are a lot of acronyms and things that go into the presentation like this, so we may have some questions. The committee and I may have some questions around that. This is my third time listening to your presentation, so thank you for the completeness. Thank you for taking our questions in advance. One of the things, just to remind us before we get started, you had mentioned just like us as individual homeowners and property owners, there are a lot of trends. A lot of my questions, John and Christy, are around trends in the marketplace. You've touched on some of this, and going forward, you had made some, I believe there were statements around you see some potential softening in the market in terms of our property valuation. Could you help us understand a little bit more of what you're seeing for the future? In our fiscal year starts in 6 weeks, but what do you see heading into calendar year 2026?
So calendar year 26, you're saying, right?
Right. We're currently, in other words, as maybe over the next 12 to 18 months or so, what trends? We've seen some huge, price increases across the board, and what are you seeing?
Yeah, so when I look at the general marketplace right now, the two most challenging lines still is the auto and the umbrella lines, and we're still continuing to see, call it 10% increases or more on those lines of coverage. What we are seeing, though, is, for instance, on the property insurance, the underwriters last year reported, i.e. in 24 calendar year, they reported favorable underwriting results, i.e. they made profit. And so what we're starting to see is more underwriters are coming in to write property insurance, so that's creating some natural competition in the marketplace. So depending on our risks, we are seeing, as the year has gone on, we are starting to see better and better renewals with lower rates, for instance, on the property. The general liability for the first $1 million of coverage, for instance, we said, I really think that's trending right now. As of this point in time, that's trending to flat. Both of those, property and liability, what do I see happening going into next year? Property is going to be dependent upon what does the catastrophic activity look like from a weather perspective. the hurricane season, the wildfire season, the earthquake season. And so if I was to estimate into, i.e. into, January of 26, I still think property is going to look pretty favorable. I still think liability is going to look pretty favorable. Property more favorable than liability. Auto does not appear that that's trending down, so I'm going to continue to say auto in 26 is going to be 10% up. Umbrella, I think that will continue to be at least 10% up because of the catastrophic claims that we're seeing there. The D&O, we've seen some downtrend, downward pressure, softening, lower prices on D&O. I continue to think that that will be mildly favorable into 26. Cyber, that's on a slight downward trend, and I would continue to believe cyber would be on a slight downward trend in 26 as well. What the industry is always looking for is what's the big claim that could really take out a lot of insurance companies. So take a cyber incident. Let's say that there's a client that buys $700 million of cyber insurance and we have $1 billion cyber incident. Well, think of all those carriers, they lost $700 million. That will have an impact if we have those types of situations take place.
One more question for me before I turn it over to my colleagues here. Is there any, it doesn't appear to me, I was just, looking around to remind myself as well, it appears that we're doing a pretty good job of managing our claims and we don't have any areas. Were there any areas, or did you, in the course of the review, see anything that we could improve upon that would make us better candidates for premiums in the future?
Yep. Great
in
question.
Property and casualty. I mean, we've already done that with health and with.
Thank you. That's a good question. We didn't touch on it. So in the past years, Philadelphia has always come out here and done inspections of your premises, and those inspections could look at, the property, the physical structures themselves to make sure that they're in best quality. They could look at your driving practices that you have. They could look at the, layout of, common space to prevent the injuries and stuff. Cincinnati has not come out to see your premise. Pretty sure they will get a meeting set out and they'll do a walk around. But in general, as you mentioned, the best way to keep your costs down is to prevent the claims from not happening in the first place. You guys have done a really good job at that. And so the things that you're doing should be commended. You have had some minor claims and you buy insurance for that. And so those have been paid. So everything is working. So there is nothing that underwriters are looking at that would say, their driving policies are not in compliance, or, their sprinkler system is not up to snuff. There's nothing like that that's been jumping out historically, but underwriters will constantly be looking at your location.
Thank you. So why don't I turn it over to my colleagues? If there are any questions? Chris?
Thanks. It was a really helpful presentation. I had a lot more questions until you got through all the slides. So you presented a lot. I'll throw out a two-part question. Number one is, if you could think about why Cincinnati decided to expand and accept a property like ours where they didn't in the past.
Yep.
And then number two, when I compare this to our personal insurance that we get, and you mentioned that we had a 10-year relationship with Philadelphia, so I'm a little worried. Are we going to have a honeymoon with Cincinnati and then worry about it next year, right? And now we kind of, I doubt if we burnt our bridges, but we certainly did break a 10-year tie with Philadelphia. If you comment on those two items.
Yep. So I think the first question really involved, why did Cincinnati decide to look at your account this year compared to past years? I'd like to give Christy a little credit, maybe. Maybe she's a pretty good broker. That could be. The other, there's a series of factors that underwriters, when they look at risks, that they're looking for. And I think, you know, when we go out to the market, we give the underwriters price targets that we want them to try to hit. And as we gave them the price target and he looked at the mixture of risks that he saw in this account, he felt that he could be competitive. So that's one thing that we do to get in there. Philadelphia as a business, is they're looking to keep growing their business. They're looking at other industries from what they have historically written maybe and have seen value in this type planned communities. Maybe they've started to see some value in these types of accounts. And so I think I would really classify it then in conjunction with the losses, you know, and you know, you have to understand when we go to the underwriter, you know, Christy mentioned, for instance, there were some underwriters, we were more than happy to work, for instance, with Chubb Insurance, who really wanted to write your property. I just had to find somebody to marry them up with on the casualty to be price competitive. So there's a lot of, I guess I would classify it as soft reasons why they looked at it, but I think you guys should give yourself a little credit that you have a nice risk. That they don't mind it. We always risk when we move accounts from, you know, one carrier to another, and are we, you know, destroying goodwill? Are they buying our business? I think is kind of what you were saying. And we had a lot of conversations. You can't get a 2-year rate guarantee. Way to kind of clean up they're buying my business is to get a 2-year rate guarantee, and we can't get that in the marketplace right now. Underwriters have to buy their own level of insurance. And so, but when we looked at the savings, even if they take the price up next year, which we don't know what they're going to do, so please don't take that as gospel, but we're starting at a lower point than we were with Philadelphia. Philadelphia took the price up for the last, you know, I can't remember exactly, but let's say the last 4 years, Philadelphia has been increasing your price every year. And so it was very delicate how we dealt with Philadelphia. I was dealing at the senior level management. They were calling me wanting to retain your business. I was telling them you're not enough price competitive. You're still 10% too high. You need to cut the price, and they couldn't cut it any further to get there. So they had every chance, I believe, and then some to try to keep your business. They chose not.
And quick calculate, Cincinnati's about 11%, 11.2% increase for us from this year. And I think we're talking 22, 23% with, I just did it quickly in my head. Mm-hmm. And then you followed up with, you've worked with Cincinnati. That was one of my other questions. You've dealt with Cincinnati before. So I'm thinking that if they had a nasty reputation for buying business and then coming back the second year, you'd be aware of that. You know, I understand they may raise our rates next year, but it would make sense why they would. If
it's the market driven.
Right.
And Cincinnati did have one selling point that kind of helped that. Philadelphia, year over year, on the building values, were increasing them on their own without working with you guys to come up with a limit to put on the building. Cincinnati is not going to do that. They're going to, at the renewal, we'll look at the building values, and if there are any that maybe want to increase for inflation or anything like that, we can do that on an individual basis rather than the carrier telling you that they're going to make those increases.
You know, there was an interesting, you had a slide with Philadelphia explaining that they're doing like a 5% increase basis. And then there was a second bullet point that referenced our revenue increase. Explain how that, is that from business loss only, or why is that an important driver?
The liability is where your revenue increase is rated on. So what the revenues you bring in on the bowling alleys and the golf courses and anything you make revenue on, we submit that to the carriers, and that's where they get your liability rating.
So their assumption is that revenue is directly there's a relation to risk to revenue, right? Even though we kind of know the details that our revenue went up and our activity didn't really go up much, but okay.
Yeah, and just so you understand, the revenue figure was provided by you guys.
Right.
That's your estimate. You guys are projecting.
There was a time, Chris, it happened in this year. Something went wrong on one of our golf courses, and it was because we had the vandalism, I believe, and we closed one of our golf courses for a week unexpectedly. And there was a conversation, as I recall. Cliff can fill me in, but there's a conversation: would it get to the point where it actually would go over that limit, if you will, to prompt a potential claim? So I think that was part of there is a lot at potential stake for us, so I can understand that. So we're going to move on, Chris, if that's okay. Rick?
Yeah. First of all, I wanted to say that I've been dealing with Cincinnati for over 20 years back in Illinois, and they've been very good from a service standpoint and extremely good from a response standpoint. I've also seen my premiums at a lower rate back there than I have here with Travelers. So I just wanted to give that. And one question I have, and maybe Cliff can answer, we have a $67 million asset. How does that correspond to our reserve fund and, the assets within our reserve fund?
That's a good question. So one of the things that kind of gets overlooked in having insurance is that you protect that reserve fund, right? Because you have insurance to cover property loss, replacement of property, those types of things. So, and also on the liability side, if you have enough insurance on the umbrella, you don't have people going after your reserve fund to be compensated for a liability issue. So, but I was going to ask, John, can you talk a little bit about that blanket coverage and how it works? Because we have different property values, and what happens if we have a claim somewhere and it becomes higher than what we actually have the property valued at? How does that work with how the coverage works?
Yeah, so you guys have many buildings. Let's say this building here is worth $10 million and a building across the street is worth $6 million. We take the aggregated value of all of those and we got to 67 million. That excludes the contents, okay? How the insurance works though is, let's say this building here that we're in burns to the ground and you submitted a $10 million cost for it. Well, we do the construction after the loss and we identify that it actually costs $12 million to replace it. But because you buy, and the way we've structured the property insurance, you buy a 67 million blanket limit, and so you can collect that $12 million to replace this building that we only submitted for 10. So that's one of the important features of how the property policy is designed. That's kind of called a blanket limit of insurance.
And that's why it's important, because the property values dictate or impact the price of the premiums. So with Philadelphia increasing the property values every year on us, and they have been significantly, that's impacting the premium cost for us. And we have this blanket coverage that says, I mean, knock on wood, of course, something's not going to come through here, a catastrophic event with all the 54 buildings that we have and take them all out at the same time, right? You probably have one or something that happens with a fire or something like that. With the 67 million blanket, you have adequate coverage. Even though you have all of these different properties, you still have adequate coverage to really cover you in case something happens. So that was all part of the assessment of looking at the different carriers as well.
Thanks for the clarification. I'm going to go to our online committee members. Ed, any questions from you?
No, not at this time.
Thanks, Ed. Mickey, any questions?
No, thanks. Mine have been answered.
Excellent. So I'm going to open the floor to any questions from our owner members. While we're waiting for those, because I pulled out my phone and did the calculation that Chris so wonderfully did in his head, because I don't trust my head at 9 o'clock in the morning. So just so that you're aware, you can run the numbers yourselves as well. What we were looking at here was our incumbent carrier was a 23% increase, and the new proposed carrier is 11.3. So you did Again, Chris is great at the math in his head at 9:30 a.m., 10 o'clock actually. But I just wanted to assure us that those are the actual proposed numbers. So any questions from anyone in the room? And there are none online. Any other comments or questions, Cliff, about what your team's done?
None.
Okay, great.
Great job.
Thank you guys for your time, and most importantly, we'd like to thank you for your continued trust and confidence and working with us. Christy and I take everything very serious, so we're very grateful to continue to partner with you. So thank you.
Thank you. It's always great to see you, and we look forward to seeing you next year.
Cheers.
Thank you. And for the committee and for our owner members as well, just so that you're aware, this is, we review all of the insurance renewals here in Budget and Finance, and this is the last one of the year. So, but always the one we look forward to, John and Christy. No, thank you for that. So we'll move on then to 3.02, which is our March, April year-to-date financial reviews. We've been anxiously waiting for these, so thanks, Cliff.
Thank you, Director Novello. Good morning, everyone. I'm going to go over the April year-to-date financial statements and closing the year out. We got May and June yet, but this will give us a good look at where we're at. We still do have some, 2 months to, finish the budget year out, and we're focused on that now. But we'll talk a little bit about where we're at through April. So boilerplate stuff, we're going to go through everything. We're going to compare it to prior year. We're going to compare it to budget. So let's take a look at the current month. So for the month of April, compared to prior year, we're 73,000 compared to prior year unfavorable. Golf, and you'll see on the year-to-date numbers, we're behind in golf. We're about 4,000 rounds behind budget in golf. And honestly, I don't know what to attribute that to at this point. We had some weather stuff happen to us in March that impacted us in the beginning of April, so that's making an impact. But we are running behind prior year by about 4,000 rounds. On the expense side, kind of interesting. Looking at the budget, we're 54,000 favorable, and we're pretty much right on budget for the month of April, 2.5 budget. So overall, 19,000 unfavorable compared to April last year. Now looking at prior year, 24,000 unfavorable in April compared to prior year, and you can see the revenue expense there. More importantly, let's look at the year-to-date numbers. So year-to-date, you see 474,000 unfavorable in revenue. A big chunk of that is golf. We talked about that at 332,000 compared to budget unfavorable. And then we've got, looking at events, the events department, 126,000 unfavorable. A lot of weather-related events there, as well as just, we've had a tough time in that filling some positions in there to get the right people in, and you don't have the people to run the events. It has an impact, obviously, on revenue. Now, fortunately, there's an offset on labor savings. We have about 84,000 in labor savings in our rec and events department, so that'll offset that 126,000 unfavorable in terms of expense. But you got to get the right people in there, and you got to get that. We got to get that filled to do that. And we've made measures, we've made steps, we've filled some positions now, so we feel like we're in good shape. But that's been a struggle this year. On the expense side, $1 million favorable compared to budget. Wages and benefits, 676,000 favorable in wages and benefits. And if you go down in the supplies and services, the bulk of that is fuel prices year over year, or compared to budget. 108,000 favorable there. And then on the service contract side, there were some things that we wanted to do this year, but with the turnover in our leadership, as well as the hiring of Kyle as our IT director, we're really taking some time to assess some things that we put in the budget for FY26 that we're not going to spend this year in service contracts. And that's down in the legal, professional, and ops other. That's where that service contract is. There's about a $70,000 favorable in there making that. And then some of the other stuff is we're still working on our security cameras. That's about 40,000, which we'll get that done before the end of the year. Get that done in PO. So I'll talk a little bit later about the wages and benefits, but I want to get through this presentation, and we'll talk about that line item, favorable. So overall, 579, favorable to budget, and income from operations. Compared to last year, we're favorable to last year, 190,000. So wages and benefits compared to last year were 485,000 unfavorable. That's what's making up the bulk of the 710,000 expenses. So that really shows that we've really held the line on our other operating expenses in our budget and compared to prior year. So in the capital section, APF fees right at budget for APF fees for the month of April. And then looking at the unrealized gain, 25,000 in valuation change in our reserve fund and unrealized gains. The investment income was 24,000 above budget, which is pretty good, pretty favorable for us, for a total of 55,000 favorable in the capital section. Compared to prior year, 14,000 favorable in APF fees, and we had an unrealized loss last year in the month of April of 665,000, so that's a 690,000 favorable variance. But you can see that income, investment income is 17,000 favorable year. Looking year to date compared to budget, we're on a little bit behind in APF fees. May is holding steady, but we're 106,000 unfavorable to budget on APF fees. Fortunately, to make that up, we are 118,000 favorable in investment income. So that's good. That's kind of making up for that unfavorable. And the performance has been better in our reserve fund, so we're 648,000 favorable in unrealized gains and losses or investment change in our reserve funds, and 179,000 in realized gains and losses compared to budget. We don't budget that, but that's factored in, of course. So 671,000 year to date in the capital section favorable. And then looking at compared to prior year, all black up here, which is great. Favorable everywhere in APF fees, investment income, and valuation change, and realized change as well. So 330 year to date compared to prior year. So APF fees, we're 86,000 ahead of prior year, but in terms of transactions, we slipped in March. Was a big month. We slipped in March. Last March was significantly higher than about 34 transactions. We were even coming into February, most part. So we were about 30 transactions behind last March. It's about a 4% change. We're still favorable in that revenue line item because we increased the fee for APFs, but that's what's creating that year to date compared to budget, 106,000 in APFs reduction to budget. Good news, reserve fund valuation change is plus 561, which is awesome. So compared to budget, 1.2 million ahead of budget when you factor in the operating cash flow positive variance and the capital related positive. And then compared to prior year, about $500,000 favorable to prior year. Moving on to capital expenditures, if we look at our budget for this year and capital expenditures in FY 24-25, 9.9 million budgeted. We've PO'd 9.6 million, approximately, of that. And we have a positive variance of 373,000. So we've outperformed what we estimated in our budget by 373,000 when it comes to those capital improvement projects. We'll be presenting a facts and findings coming up here. We've got some carpet in our billiards room that's buckling, and we're not getting the useful life out of that. So we'll be presenting a facts and findings to get that project done this year, and we'll request to use some of these savings to take care of that. So that is on the reserve study. It wasn't on in 27. I think it was on in 28. So that carpet has been extended. It was up probably 6 or 7 years ago, and we've extended it further and further down the line, but it's time to do it. So we'll present that to the governing board at the workshop. And the details to those savings are listed here in this sheet. Looking at the allowance funds, 420,000 budgeted. We've spent 356,000 on these, and 90% of this, maybe 95% of this, was just reserve study items that we did not get the useful life out of, that we thought we would. We had to move those up and use allowance funds to cover those for this year. And then, of course, if there's a well pump, Echo's well pump at 109,000 is a pretty big impact into that allowance spend. All right, so we're on track, still on track to hit our FFB budgeted goal of 47%. These are all positively impacting that. I will say that, at the time, at the end of the year, we'll have our fully funded balance, which changes daily. So I can't really give you here's what our FFB is right now, because that changes on a daily basis. So we'll calculate that at the end of the year, but with all the positive variances, we'll be in pretty good shape. We're definitely on pace to hit our 47%. So I wanted to talk a little bit about the positive variance in wages and benefits, if I can do that, Christine, because there's.
I was going to ask you anyway, so
Okay,
great.
great.
Yeah.
Oh, thank you. When we put our budget together, we've talked extensively about how we do that when it comes to our positions and how we assess those positions for every department with every department head. And those conversations really start down to the supervisor level with the department heads when they're talking about, do we need these positions in our budget? And we've presented, we made changes. We've reduced headcount here. We've added headcount there. So there are changes within headcount. And then we do the FTE trends, and you can see, in 2022 it was 310 FTEs, and in this budget it's 300. It's gone down to 293 and back up to 300. But there are changes yearly in our FTEs and in our budget when it comes to headcount. And when we put the budget together, we have to put the budget together for positions that we need. And the positions have hours assigned to those positions. So what needs to be done? Talked a little bit earlier about all the statistics around our resource inventory. 4 miles of wall, 54 buildings, over 300 toilets and urinals, or 275 or something like that. So all of these things take people to manage, and it really, the maintenance program that we have here it's never ending. It's extensive. I compare it to, you could give a bucket to somebody and tell them to empty an ocean. You could just keep throwing buckets of water out of there, and it's not going to go anywhere. There's always, but the reason for me saying that is there's always things to do. And if they don't get done, then they get delayed. So when we put our budget together, that's what we do. We think about the things that have to get done here, and we know historically what has to get done, and we know what resources we have to do that. So if we look at that 676,000 in favorable savings and wages, I did an analysis on that. Where's that coming from? So where is that savings departmentally, divisionally, where is that coming from? Well, I can tell you, in golf and landscape maintenance, there's 64% of that is applied to that, just golf and landscape maintenance. And those are people that if they showed up today, we would hire them. There's so much work that we have to do, and Todd could stand up here and talk for hours on what he knows needs to be done that we can't do when we want to do it. But we also offset that 676,000 or 64% of that with outside sources, so outside labor. So if you dig into our P&L, you would see that we are 230,000 unfavorable in outside services that we've paid outside companies to come in and do the work that we can't do. So even though it shows a favorability of 676,000, there's 230,000 of that we've spent to have outside services come in and do because Todd just doesn't have the manpower to do it. Okay, but I just want to read this because I think it's indicative, not only in golf but just in general here. And this was the PGA report that we got on golf. And there's a section in here, it talks about observations and recommendations, and this is in golfer expectations. So bear with me, I'm going to read this, but it's important. This report was written, first of all, written by Brian Whitlock. He's with the USGA, and he's in the West region. So he's an expert on agronomy and course maintenance. This is an expert. He handles the whole Western region for the USGA, U.S. Golf Association. And this was his assessment of us. 1, high expectations, low staffing. It is apparent the expectations and quality of the course care at these 7 golf courses are not necessarily aligned with the budget for staffing. There are only 10 to 11, we budget 12, but currently we only have 10 to 11 staff members per 18-hole golf course, which is 3 to 4 fewer staff members than I typically see at public golf courses. There are a few municipal properties in southern Arizona that only have 7 to 9 employees. However, as you might expect, the level of conditioning is quite poor. From my experience, for an 18-hole golf course, you need 13 to 16 employees to provide good quality course conditioning. Higher-end golf courses will typically have 18 to 23 staff members per 18-hole course. The higher-end private courses typically have 25 and as much as 40 employees per 18-hole property. The amount of labor budgeted for these properties at the rec centers of Sun City West is below average, yet the expectations remain high. There is only enough labor to conduct routine mowing and golf course setup. In the summer, when mowing requirements are higher, even that amount of maintenance is difficult to complete. For those reading this report that are not familiar with behind-the-scenes work in the golf course maintenance world, there is no real magic to producing high-end quality conditions. It comes down to having enough people, having excellent equipment, and dedicating the team to very frequent mowings and attentions to detail. Frequent mowing at low mowing heights is a sure way to shine up golf course and improve aesthetics and playability. However, the amount of labor at these golf courses is not set up to accommodate this level of maintenance. So this was an assessment by a guy, an expert on what it takes to maintain a golf course. And we're 2 to 3 employees per course that we budget less than what he's recommending. Yet, we show favorability in that area because we can't fill all of the seats that we budget. I wanted to point that out because I want the community to know that we're budgeting what we need. We really are. We can get by without it, but that work doesn't go away. It's perpetual, and it stays. And if if it's something that has to be done, we have to pay somebody else to do it. If it's something where we're trying to meet the expectations, and we have 28,000 members here in the community that all have different levels of expectations, we have to meet those expectations as well. So that's what we're trying to do in this budget. And that not only applies to golf, it applies to everything here. That's what we do. We're recreation. That's what we do. So So that's 84%. I'm sorry, yeah, 64%, excuse me, of the overall savings comes, of favorable variance comes from golf and landscape maintenance. 20% of it comes from facilities maintenance. That's the building maintenance that happens around here. That's all those things that I talked about in this resource inventory that have to be done and be maintained by staff. And again, if that toilet doesn't get fixed today, it's got to get fixed tomorrow. If it doesn't get fixed tomorrow, it's got to get fixed the next day. So these are, the amount of maintenance and things that have to happen around here is endless. It can go on forever. So that's why we put these in the budget. You might be, one person might say, well, I'm okay with that condition of that because I don't use that facility. Or I'm okay with the condition of that because, you know, I'm just fine with it. Well, another person may say, no. We had a lady come up at our public forum and said, hey, how come you still haven't done the Kuntz tennis courts yet? Who needs to be fired? Basically, because we haven't done it. Okay? So there's different expectations in the community. This work doesn't go away. It has to be done. So that's why we put it in the budget. And if they, again, if 10 people showed up today, 7 landscape people and 3 maintenance people showed up today, we would hire them. We would. Okay? And these are areas where there's high turnover. Not because it's us, it's a fact of life. If you look, I looked up some statistics at turnover rates in golf maintenance. The USGA says it can be up to 50% at a golf course, a turnover rate. And that turnover rates typically vary between, the average varies from 20 to 37% turnover rate for golf maintenance. Okay? It's a very high turnover area. We're doing our best to keep those positions filled, to be competitive with wages, and provide conditions in tough conditions for employees to stay and work. So we're doing all that. I just wanted to give some clarity, and thank you for the opportunity to do that. And I'm finished my presentation.
Thank you, Cliff, and thanks for the clarity on how staffing is assessed and budgeted. I asked this question at least once, if not more than, I think more than that, earlier when we were going through the budget assessment process for the financial plan for the operating budget. But just to ask you to repeat again, as you and the staff are going through and you're looking at the staffing each year, do you start with a clean slate or do you just roll forward all the openings?
So what we do is we look at what was budgeted for that year. We look at what we currently have. So how many of those positions are filled? And we assess anything that's currently open. So we assess all of it. So we look at what we have that's currently there. We look at what's open on the budget. How long has it been open? Is there another way to fill a position? Should we outsource this position? We've done that in budget cycles. That's what we look at. And it really is an extensive process because 63% of our overall expense, labor, and wages, and benefits. So it's a very important line item. And we want to be able to justify, of course, what we have and what we put in the budget. So those conversations start from department heads down to supervisory level when they're assessing that. And then when we set our meetings, the general manager sits in, Terry and I sit in, and we expect our managers, our department heads, to justify every position that they have. Every position. Now, when we put the budget together, we know there's going to be turnover, but we can't budget turnover. I mean, we can't put a budget together to say, oh, we're only going to fill this position for half the time because historically we have turnover, so we're not going to fund that position all year. It just doesn't work that way. We have to put the budget together for what is needed in those areas, and that's been assessed by each department head and us in those meetings. And so that's how we do it, and it's an important process that we go through, but you know it's necessary.
Thanks for that. And as a reminder to all of us, the general manager and his staff have assured us all, every committee and every board member has been assured repeatedly that every intention is to fill these positions, right? It's not as if any of the positions that are opening are not required. Excuse me, let me say that again. It's not as if any of the positions that are open today are no longer required. They are all needed in the eyes of our management team. And the intention is there. We're recruiting for those.
Yeah.
No business I'm aware of that with the level of employees that we have, we're never going to be 100% staffed. At least it's unlikely at best, but you always strive for that, especially in our recreation business. So that's the assurance that we've all received. We've all asked the question.
Yeah, and you know, I've been in the for-profit world. I know exactly how it works. And I've been in production environments as well, not just service environments, both. And you work off of margins, really. That's how you justify your head count. And so when you put a budget together, it's based on what's the return on that. That's not the world we live in here. When we put a budget together, we don't do that. We're providing amenities and services to our community based on what the expectations are. And you may go in and look, if you're tracking what we have open, there are times when we have 10 positions open, 20 positions open. Some of that's just simply seasonality. Like, we have to hire 10 more people now because it's busy. I mean, that's just kind of how it works. So don't look at that and think that, oh, they, 20, they had another 10 people leave. No, in the budget, we budget for the positions at the time we need them. So that happens as well. So there's some, I just want to make sure people understand that it's a very important process that we go through, but a necessary process. And if there's favorable variance, this goes right into the reserve fund. And if it impacts the dues in the following year budget, it impacts positively, meaning it decreases the amount that we need next year to go into the reserve fund. Because ultimately, we look at the health of that reserve fund. And if these savings are going in from the budget, it's going to help reduce our dues increase request the following year. It does.
Back to the rest of the things that you were mentioning, and thanks again. A couple of questions for me. One was about the golf rounds. There's no magic here. It's always just a crystal ball sort of prediction, right? But right now we're down, a couple percent. I pulled my phone out for the calculation. Any impact, or will you and the team be revising any of the assumptions around the golf rounds estimated or predicted for next year? I mean, there was already a reduction that was estimated in terms of total number of golf rounds going into fiscal year 25-26. And do you think that the current softness is any indication, or are you holding steady on that?
Yeah, we're going to hold steady on 320,000. Obviously, like you said, we don't have a crystal ball, but when we look at the budget, again, if we look at it as a whole, there's some conservatism in there on the revenue and expense side. We try to budget it to our best estimate where, but we know that there are some things that are just out of our control, especially, member dues. We know we're going to collect it for the most part, so that's pretty guaranteed. Golf rounds, unfortunately, isn't. But we're not really seeing anything that's going to, if we end up 3,000 rounds behind budget, we're about 2,400 behind budget. The number I gave earlier was behind prior year. It's still pretty close to 320,000.
Okay. Thank you. Again, turn it to my colleagues. I'm going to start with our remote participants. So Mickey, start with you. Any questions on our year-to-date budget or any of the other comments?
I just have one question, Cliff, on the wages and benefits. Is any part, I know most of it is people driven, numbers of people, but is any of it lower wages themselves?
Yeah, there's a piece of it that we budgeted trying to remember, I think we budgeted $1 increase for minimum wage. So there's a 6-month favorability in minimum wage. It came in 35 cents. So some of that is going to be favorable just due to budget, and that was just uncertainty. This year we put a 50-cent increase in, but it was the uncertainty with the $18 an hour. That's a good question. Thanks for pointing that out.
And my other comment then is just to reiterate what you've said, which is, I think that the way we approach budgeting for people is absolutely the way it should be done. And frankly, it's still conservative. If we don't have the people, then yes, you have a favorable variance, but you have an unfavorable variance in terms of the work that gets done, which may show up in costs, but also may just be kicking it down the road. So I think that when we look at the number of people that are budgeted and it holds up when looking at other like organizations, is that we are not overstaffed, and we don't budget to be overstaffed. I think that we budget to do the work that needs to be done. And I would say conservatively, we're not budgeting too many people.
Okay, thank you, Mickey. Ed, any questions? Ed, you may be stuck on mute. That's okay. We'll come back to you one more time. John, any questions?
Yeah, thank you for the labor explanation. It brought back similar conversations I've had, eerily close, so it was kind of fun to listen to. I'd mentioned in the past that my last job, post-retirement but pre-permanent retirement, was a part-time controller at a country club in Portland. And I don't know why I remember this because I'm trying to forget it, but their maintenance staff was budgeted at 13 to do the 18-hole course, a nice course. They had some loss in membership, so finances were a struggle, so they staffed it at 11. And the greenskeeper wanted 15. So almost exactly where you were saying something. I was just bringing back eerie memories. Amazing thing was at 11, the course was in fantastic shape. So the things that didn't get done were the peripheral things they wanted to do, like debris removal, or I can't even remember what they were. So like you say, you're deferring kind of the things you want to do, but the course was always in fantastic shape. So the other thing you mentioned that brought back memories was constantly one of the crew members would come in to the greens superintendent and get an offer from one of the competitive clubs. There were like 11. It was constant. I'm making $17.50. I just got $18.50. So in the short period of time that I was there, that scale was just constantly moving up just to keep people. So everything you said just came back from my experiences, the same thing. So the only other question, I just wanted to say that, but it was fun to listen to. The only other thing I would say is on the last slide where we're talking about the reserve fund, and I'm adding up all those green items, and I come up with $1.2 million or $1.4 million or something. Mm-hmm. And so just want to make sure I understand. So at the end of the year, if we kind of finish out the way we're at, we're going to put $1.4 million more into our reserve fund from how we did in the operating budget and how we did in the capital budget than we budgeted. Did I get that right?
Yes. 561 of that currently, or not 561,
is reserve.
Is reserve valuation change.
I get that. Yeah.
So there's a big portion of that's valuation
Paper
change.
money.
Actually, it's actually called out.
So I add up the green.
We don't call it out on here, but yeah.
So the reserve fund's benefiting this year from
469. Yes.
So that's good. That's a very good thing for us.
Yes. Now we have we roll the year, so we have the inflation impact and the 1 year reserve.
Right.
use impact that's going to hit the reserve fund as well. So,
Right. But for this year, it's good, but
yes,
as you make your changes
as soon
going
as we
forward,
roll
it starts
July 1,
absorbing. Yeah,
absolutely.
Yeah.
Yeah.
okay,
So we'll assess it that way.
great. That's what I have. Thank you.
Thanks, Chris.
Cliff, thanks again. Good job as usual. You know, when I looked through this, I took three notes that I wrote down, and one were APF, and another one was golf, and another one was wages. I'll start off with the easiest one and give you a compliment. So even if we were perfect, almost perfect, luckily we'd have a positive in that wages. I mean, we're always going to have some openings, right? And our number of openings aren't that high, but they're, you know, because we have close to 400, I think it is, you know, positions, we're going to have a positive. But what I want to do is tell you that what you did today, and maybe it would even be better on a slide, is explain what we should be concerned about. Because, you know, we should not be concerned about the fact that we had a monitor open for a week and a half over here and a monitor open for a week and a half over there. We should be concerned that we may not be able to take care of our golf courses the way we should be able to take care of our golf courses. And I'm not just talking about golf courses. It could be facilities, which you mentioned also. So, you know, what you did today, the only thing I wish was on a slide, right? Because, you know, people glance through slides and fast forward through presentations sometimes, is broke that number down that seems to be getting a lot of attention and pointed out, if we have a concern, this might be where the concern is. Golf was a big number, but golf, again, we're not terribly off golf, but it's something that I think that operations should look into and be able to explain a little bit better. You know, are they weather days? Did it have something to do with the damage to the course that happened, or something of the fact? And then the most interesting one that I found was this is the first negative budget number that I saw regarding APF. We've been on APFs all along, which kind of tells me, you know, and I'm not worried about the APF fee. Again, I'm a person that I don't think people say, I love everything about Sun City West except that the APF fee is $200 too high. I don't think there's anybody out like that, right? If there is, I'd like to meet them. Instead, it's just a concept of, you know, how desirable is the community, and compare that with the overall housing. You know, if all housing changes are down or we're down, okay. If all housing changes are stable and we're down, we have a problem, right?
Mm-hmm.
Vice versa. If we're up in the housing, then we're doing great. So this is the first time I've seen that, which means we should continue to pay closer attention to it. But I want to thank you for that breakdown on the wages, because it really added clarity.
Yeah, building on what you were saying, Chris, about the real estate market transactions in general, I've been told anecdotally when I've asked that houses in general seem to be staying on the market longer. I don't know if that's the source of this, but it is something that I believe all of us need to be paying close attention to, just in general, what's happening with the real estate market. Remember also that we had a change to the law in the fall that APF fees are not collectible any longer from a family transition, right? So I'm not sure, and I don't know if we know yet whether that's contributing, but it is something that I believe I would have to agree we all have to pay attention to both.
Indeed.
Rick?
Okay, thanks, Cliff. One of the things is I read that exact article, so I was very aware of what that was saying and how it meant to our community. The other thing is that I agree with John, that business and the golf club maintenance business, those people are going after nickels and dimes and quarters every year. So if you get someone that gets another quarter an hour, they'll move quickly as possible. So it is I don't want to use the word transient profession, but it is, though, money talks. The more money that you can get, the more people will move. And the last thing in my career in history, the way we go about budgeting staffing is very well appropriate because it's all based on the work that needs to be done. So you got to pay for it somehow, or the work doesn't get done. It's either through people, through overtime, through outside services. You have to budget that way. That's the only way it'll work. So.
Yeah, we've been forced to change really over time. I mean, if you look from 2014 to 2022, we've averaged 99 FTEs budgeted in golf maintenance. And for the last 3 years, we've been in the 80s. So we've decreased our FTEs in golf maintenance historically by 10 FTEs. Now, we subcontract those services out now, aeration and things like that, which there's a return on the equipment side and all that as well when we do that. But there's a lot of, we used to do capital projects in-house for the golf course because we had the staff to do it, which was incredible. I think Todd got up here and talked about, we saved $7 million doing bunker projects that we now, that's in our reserve study now. We're gonna have to pay somebody to do those. And those are coming up in, I think, 4 years. It'll be our first go at some bunkers at some courses. So.
The other thing I'd like to see is where's our staffing related to Desert Mountain, which we should compare ourselves because we're pretty close with the number of courses we have as a community. I mean, those are the two biggest communities in Arizona, and the Golf Association said we should probably compare to them, even though their rates are probably outlandish, but that should be a good comparison. And you can tell when work's not getting done on the golf courses, but you don't have that much turnover in the bowling alley, you know, because the people like that, they are very technically into it, and that's why you keep them. So
It's nice and air conditioned in there as well.
that's true.
A little noisy.
A little noisy. That's true. Good comments. Do we have any of our owner residents who have any questions or comments in the room? For those of you who are watching online, we do have a small but strong audience here today, so there aren't a lot of folks. And I don't see anything, no comments or questions online yet. There's always a delay between what our folks who are watching online hear and see and what we're doing in the room. So if there are questions that come to you, we still have time to address those toward the end of the meeting. But that seems to be it for the comments or questions on our year-to-date financials. So thanks, Cliff. We'll move on to 3.03, our proposed fiscal year 25-26 operating budget. Any changes or things that you wanted to review with us?
No changes. Nope. Looking forward to Thursday.
Yes. Sure, Rick.
With the renewal of the insurance we saw today, how is that compared to what we have in the budget?
It's good. We put an 8% increase. Our premium period goes from April 1st through March 31st, and the increase is year over year. So we feel good about. We double check that. We feel good about the numbers.
Okay, so we're covered. Okay,
yep, we're good.
Thank you. And again, I had already asked a couple of questions about no changes in assumptions around APFs or so forth. We're only, by my calculations, about 2 or 3% off, which is not huge numbers in terms of off year to date this year for APFs and golf rounds are already predicted to decline next year. So that was already built into our revenue forecast.
We budgeted 320 for next year. We budgeted 320 this year. It's a decline from last year. We ended up at 326 last year.
Okay.
Yes.
I must have been looking at the wrong thing, but we're predicting or we're projecting remaining flat, which is, and everybody's still confident with that. So it's sort of a one more time. This committee has in 3 different meetings now said that we didn't have any issues. So it's a little tongue in cheek. It's a speak now or forever hold our, well, maybe not forever. Any concerns or questions that we want to have? One last question before this has already been forwarded for vote to the governing board regular meeting this Thursday. Any questions for Cliff? All right, there are no questions or changes from us, so our recommendation stands. Thank you, Cliff. That wraps up our new business for today. So we'll move on to section 4, any committee comments. We will start with Rick today.
I've been thinking a lot about what's going to happen to this community next 5 years. The past 20-some years, this community has been built around the baby boomer generation. That is now starting to change, and their expectations are different than what we had experienced over the last 20-some years. I'm really concerned that we need to think about what's going to happen in the future, not just what we're doing today, but in the future, and how we are going to attack some of the pitfalls we have coming forward, especially because the whole not the community, but the pool of available applicants or people coming into the community is going to be much smaller than what we've experienced in the past. And that's going to put a lot of pressure on our housing, our community, how we market our place, and how we move forward. So I just want to say, I like the strategic plan. I'd like to hear the master plan, because the next 5 years is going to be very critical in the survival of this corporation or of the community. Not saying it's going to die, but I mean, the demographics are going to change substantially over the next 5 years. So that's just my comment.
Thanks, Rick, for the comment. And again, it's a very interesting time to be here in the Sun City West. We're at we're making some pretty significant moves forward. We have a strategic plan that we've talked about quite a bit. We have a master plan that will be kicking off. RFP will be generated and kicking off once we've actually officially forwarded the budget to the general manager. So lots of great stuff happening especially in the next year or two around those. So thanks for the comments. Chris, any comments or questions?
Yeah, sure. If you're interested in the 25-26 budget, that's going to be passed, I think, I don't know if it's the next meeting or the next general governing
On
board
Thursday,
meeting.
the 22nd. Yeah.
If you're interested in 25-26, you might be interested in 26-27. And just about now is the time to start attending these meetings and to fully understand the budgets that's coming up, because it takes a long time and there's a lot of discussion. And at the very end, the last month, you're kind of reading the results instead of being part of the process. So I encourage everybody to watch these meetings, to attend these meetings, to come up and voice their opinion, because it's really important. We need more people involved in it. Thank you.
Yeah, really well said. And now's the time to be thinking. Yes, we're looking at the results. The vote will be at our regular governing board meeting this week. And that's the vote on the fiscal year budget, but immediately we start discussing the next round. So this is the time to be commenting and making your impacts known for that. John?
I have no comment.
Thank you. Ed Westall? Okay, we're going to assume no comments from Ed. Mickey, any comments?
No, good meeting as usual.
Thank you. So we'll turn it to, yeah, thank you for the reminder. So any other comments from before I have a couple of things that I'd like to say. So no final comments. One of the things that we were mentioning, we have a lot of meetings still left to go. Really want to thank our Budget and Finance Committee because we're standing tall. We're the last committee still meeting because we still have a budget that's open, right? And so forth. But we wouldn't be here working so well, as Chris was saying. It's a long process. But one of the things that we are very grateful for is that we have great team that works really hard. And one of those another one of our team members, this is his final Budget and Finance meeting with us today. That's Mr. Finelli. So Pete Finelli is retiring, and Pete has held a variety of positions here at Sun City West. And those of us who have been around for a while know very well all the contributions, but part of what we depend on now is sort of take for granted in a way is the reserve study. And when I think reserve study, I think Pete Finelli. Pete's done so many things, and I don't want to single just that out because Pete at one point was our CFO. Pete's been really very instrumental in guiding us and guiding me in my understanding of the reserve study. So I wanted to say, on behalf of the Budget and Finance Committee, thank you, Pete, for all your contributions. You will be missed. I would not be surprised if other similar communities came after the now soon-to-be retired Mr. Finelli and asked for his expertise. But again, we are beneficiaries of that, and thank you. We're very grateful. I don't see any comments online. Are there any comments or questions here in the room? So our next Budget and Finance Committee meeting will take place right here in the lecture hall on June 3rd. We'll wrap up the year. We assume that we'll wrap up the year at that time. We do have just a couple of quick things to discuss at that point. But we'll, if you're interested, as Mr. Waller was saying, please join us. This is the time to start becoming engaged if you're not already engaged. So thanks again. We'll see you on June 3rd. This meeting's adjourned at 10:49.